Okay, 9 o'clock. I'm going to get started. I'm very punctual on this kind of stuff, and so I want to get going. Um, let me I think I can minimize my and to maybe is the screen size okay, and you can see the projection. I think I can minimize, my ugly self there, so everybody can see the screen. I'm sharing the screen, so it should just say Options Meister with the beginning slide. Okay, great. Thanks, Jay. Let's get started then. And like I said, we'll see how when I click on the slides, we'll see how it goes. So, okay, today I want to talk a little bit about trading earnings, and I'm going to review the earnings releases. Some of you that are in here today are members and know what we experienced in the first quarter, but I want to talk a little bit about how I look at earnings trades, how I set them up, and it's not very challenging. What I want you to keep in mind is that what I do in earnings trades is the same thing that I do on regular trades. It's not like you've got to learn a whole new set of criteria, and it just compresses the time. And typically, we're putting earnings trades on the last hour of the day with the expectation that volatility is going to expand into the end, and then hopefully it'll contract. We're in a very low implied volatility cycle here right now. So I think obviously our fingers crossed that volatility increases. But so I'm going to talk a little bit about how I do it, give you a couple examples. We'll look at what's upcoming here, and then I'll be available for questions and answers for as long as you need me. So let's get going. Okay, what is an earnings trade? That's kind of a rhetorical question, I guess. Most companies, as you know, release earnings on a quarterly basis. And analysts, which I put in parentheses, highly overpaid, which I think they are, provide estimates of results. Financial markets then assess those results. Typically, as I alluded to, you'll see volatility elevate into the release of the earnings. It's any of those binary events. You'll have volatility will expand, and then the event is announced. And the analogy that I like to use is it's like putting a pin in a balloon. The balloon expands into the event, you pop the balloon, and all the air comes out. A high percentage, I'd say a very high percentage of traders trade directionally using technical or fundamental analysis. A very high percentage of my trades are non-directional, both earnings trades and our regular trades. And I trade statistically where I think the market should not go. And I'll get into that a little bit deeper on subsequent slides. So how do we trade earnings? How do I trade earnings? Well, first of all, as I said in the previous slide, I trade where I expect the price won't go. In most cases, I'm anticipating volatility contraction. We're in a very low implied volatility environment now, which the odds still work, the percentages still work the same, but you don't get the premiums. Sometimes the premiums aren't attractive enough for me to, the risk is not, in my case, congruent with the reward. But we're typically expecting volatility contraction because as the event nears, volatility will go up and up, the excitement, the unknown. You got people on both sides of the trade. As soon as that earnings announcement is made, volatility contracts. As non-directional traders, premium seller traders, we benefit with that. Now we execute primarily neutral trades, and most of them, as you'll see, I'll show you some stats, are the strangle, synthetic strangle, which is a strangle, but we put wings on it. In some cases with IRA accounts or smaller accounts, you need to define the risk. Even on the bigger stocks, $300, $400, $500 stocks, if we're going to do a strangle on that, it makes a lot of financial sense to put wings on each side. Ratio spreads, I do some of those. Typically, I do 1-by-2 ratio spreads. I either do them on the put side or the call side. Sometimes I do both sides. I call those double ratio spreads, and like they are 1-by-2 on both sides. Oop, there's what we didn't need. Thought I had all that stuff out. Okay, and then a double ratio is as I said, I put a 1-by-2 on the call side and 1-by-2 on the put side. And then finally, naked short puts. That's something I trade on occasion. You might say those are directional, neutral to bullish, because we're selling a naked put and hoping it doesn't go below that. But That's something we'll typically do, and that's the majority of the trades that we'll do in that I do in the gold level membership, and that we do on a daily and weekly basis. Then once we select our strategy, we simply offer the trade, wait for it to get filled, and then after it's filled, I will typically set a good to cancel order to close it. And oftentimes I'll be a little more aggressive on that. In other words, if I sold a strangle for $2, I may put an order in to buy that strangle back for 50 cents or something, which I know probably won't get it. And we'll talk a little bit about if the underlying moves materially one way or the other. Often we'll take off the untested side, because we might get it off for $5 or $10, and then we're just dealing with the other side. And I've got a real live example of that. And then after I put the good to cancel order on to close the trade, market opens. I usually wait 20, 30, 40 minutes for the prices to tighten, because the market makers will take advantage of you at the open. The bid-ask spreads are very, very wide, so they really take advantage of you. So I wait for the markets to typically tighten if it hasn't filled at my good to cancel price, and then I'll adjust the price. And if I want to exit the trade, then I'll exit the trade at that time. Pretty simple. I threw in a slide of the risk graphs, of the ones we mostly do. I won't dwell on this, but it's just something. It'll be, if you want the PDF, I will upload that, and it'll be part of that. But it just gives you a little idea of the strategies that I mostly use. As I mentioned earlier, the short strangle, the put ratios, and I even added the jade lizard here, which is really an iron condor with one leg missing. So I just thought I would stick those in there for your so you can get an idea of what the risk graphs look like on each of those. Now, the key to everything we do, everything I do, is expected move. And what you see is if you're familiar with the standard deviation or normal distribution, what you see in the graph there is a normal distribution chart. And if you notice in the middle where it's a 68.3% of data, that's a one standard deviation move. In most of our trades on a day in, day out basis, we work in that 68.3% of that one standard deviation move, and we can round it off to 70. And all that means is that 70% of the time we anticipate price to stay within that range, either plus or minus one standard deviation. So if it were a $100 stock and they had a 20% or a standard deviation of 20, it would be plus 20 minus 20. So the range would be 120 to 80, and that's a standard deviation. In the normal everyday trades, the regular trades, we're typically working in the one standard deviation area. Most of the trades that I do, whether it's defined risk or undefined, are kind of in that 70% probability of success. Now, in the earnings trades, on the other hand, where you see the second line, 95%, that's two standard deviations moves, or twice the expected move. And as I've gotten more and more experience with earnings trades, I'm getting to the point now where I use those wider. I'm kind of out in around that 2 times the expected move area. And there are complicated calculations to figure standard deviation. And if you fell asleep in statistics class like I did, you probably don't remember it anyway. But the simple back of the napkin calculation, all you have to do is take the price, take the times applied volatility times the square root of days to expiration over 365. Some people use 252 for the divisor because that's the number of trading days in a year. It really doesn't make much difference. We're not trying to get down to the pennies. It's all not that material, but I can share with you a calculation, but at how to do it, the longhand, the math, but it's right on the option chain. We'll take a look at that. So a trade that I did this week, we did it on the 13th. It was Goldman Sachs came out. I'm going to walk through this so you get a sense of how I think. And I'm not saying that I do it the right way. I'm just telling you how I do it. So kind of late in the day, I'm looking at Goldman Sachs. and I don't recall what the expected move was. This thing was trading, as you can see, around 330. So I was looking at plus or minus 25 points. If I remember right, the expected move was $11 or $12. So I start out looking at about 2 times what I think the expected move is going to be. And I typically look at the front week. Now, over years of doing this, where I always used to trade the front week because I was enamored, like most traders are, with volatility contraction and, more importantly, the premium we collect expiring at 0. And I've gotten away from that, and I'll talk a little bit about that as we go on. So I start out kind of looking at about 2 times the expected move. I may tweak that a little bit initially, depending on the deltas or depending on if I'm slightly bullish or slightly bearish. I mean, in this particular trade, this is pretty much a neutral trade. You can see I'm basically plus 25 and minus 25. So I've got a very wide range. This thing is expected to move, say, $12. And we start out looking outside. And that's where I start. And that's how I kind of analyze, and I'll pick out my strikes. And then I start tweaking them a little bit. I'll say, well, this thing's really run up a lot recently. There's some good examples of ones that are coming up in the earnings cycle that, and Home Depot comes to mind because I just talked about that yesterday. It's just been parabolic. If I had a stock like that, I might be a little tighter on the call side, and then I may slide the put side down. So I might still keep the same range, but it might be a little skewed to the put side or skewed to the call side, depending. And that's all personal. What I'm thinking, that everything's, what my bias is. But this is how I start out. I like to look at around 2 times the expected move, because on earnings, we're expecting, after the binary event is announced, we're expecting a lot of up and down, a lot of movement, as opposed to if we're looking at our regular 45-day trade where we put it on at 1 standard deviation and we're just waiting for a couple of weeks to adjust it. So that's how I start out. Then what I do is I'll go through subsequent expirations. The first one, obviously, is the front week. And like I told you, I typically do not trade the front week. Most people are enamored with that volatility contraction and selling it for $1.41 and keep it all the premium. And over time, just personal experience is that I've learned to, and what works for me is to go out a little bit further, collect a little more premium, and then manage it quickly. So what I'll look at subsequent expirations, and if I did the front week for Goldman Sachs this week, you saw it was like $1.41. If I went out to the 23rd, it was $2.39. Another week's $3.65, $4.90, $5.65, and I went all the way out to May 21st, which is a regular monthly expiration, but that was 41 days at the time, so that really probably not going to do it. And I would never go out past the next regular monthly expiration when I'm this far away from it. If I was only a week or two, I might go out a week or two past that. But this is how I look at it. You're going to get the best spreads on the monthlies, but oftentimes it's just not worth the risk. And you don't really have the capital tied up that long. And on the right side, and I forgot to identify it on the first chart, I look at the probability of profit, the probability of reaching a 50% profit, because most of the time we're looking to capture, in the real world, we're capturing 50%. I want to know what the net delta is. In the case of this trade, it was about 3 short deltas. So for all intents and purposes, it's a neutral trade. And if there are questions about deltas in that at the end, we'll talk about that. So as you see going down here, as I collect more premium, you'll see just a little bit of drop in the probability of profit. Those don't really bother me too much, or I don't put a lot of emphasis on that. The deltas are pretty much the same, and this is basically a neutral trade as it's set up now. And I'm going to show you how ultimately I adjusted this trade a little bit, but I started out at the 305, 355 strangle. And you can see here at that time, if I entered the trade, I'm not saying we're guaranteed to fill, but we'd probably get filled around these prices. So that's the way I look. I start out kind of wide and tweak it around a little bit. And I find the strikes that I really plan on using. And then I look at subsequent weeks to see, where's the risk reward? If I were gonna do the front week, collect $1.40, I think it was, or something, and let it go to expiration, I'm gonna make $1.40. Do I have a better chance of giving myself more time and diffusing some of the gamma risk if I go out a week or two? And let's just say we go out to the 23rd, we collect $2.39. If the first week we could collect $1.40, we'd probably take it off for say 50%. We make $70 on the trade per contract. This $2.39, how do I think I'm going to be able to get the same 70 cents out of it as easy or easier? Plus I've got the extra time if it moves materially one way or the other. And that's kind of the way I think. And I'll evaluate the different prices and going out every 7 days. Obviously, these are weekly expirations. So then what I actually did was Goldman Sachs, I think it was the 13th. Yeah, it was the 13th. I ended up selling the April 23rd strangle. There's a couple of reasons in this case that I did it. Number one is the beginning of the earnings season. If Goldman Sachs was going to be a pain and I have to manage it for a while, it ties up a lot of capital. But I was satisfied that with the 23rd expiration. And as you'll notice here, I did adjust the prices. And this happens often. I look at something and then I get the last hour of the day and maybe the last 30 minutes of the day. And I'll say, this thing's moved. It's maybe moved a little bit from when I initially looked at it. Or, I want to skew these deltas a little bit. But for, there are a variety of reasons I may do it. But I selected the 347.5, 310, where I was looking at the 355, 305. And I sold to open this for $3.47. And you can see down here, this is off my Tastyworks platform. I was filled at 316, so 45 minutes before the market opened. And what I've done on this trade is what I preach is you put them on as an earnings trade, you take them off as an earnings trade. In other words, you put this on at 347. I initially had a good to cancel order to buy it back for $1, which obviously that didn't get hit with more than 7 days to go. And then I think we changed. I think I put a 5 cents to buy back the put side because, as I recall, Goldman Sachs opened higher. I honestly don't remember right now, but then it's kind of trended up a little bit. What I ultimately did was 2 days later, I ended up taking off the put side. A lot of people just took the trade off, which is what I would coach you on and what I would recommend doing. And, don't do as I say, not as I do. I took this trade. I'm trying to milk it a little bit. Then I forgot about exiting the trade. And most of the guys that took it and the members in the room, I saw, profits from $1.50, $1.35, something like that. So it was a decent trade. But what I've done is I took off the put side, so I have no downside risk on the trade. So 347 right now, I'm sitting with 18 cents off of that is 329. I could buy this back for probably 230, 240. I posted this little block up here what it closed at. Spreads are pretty wide because that was after the close yesterday. And I'll probably be taking it off Monday. So, shame on me for not getting it off, but sometimes I get distracted with other things. But typically I'm going to put this trade on. I'm going to collect 347. The next morning, I'm going to see if I can take my desired profit out of it. If 50% of the original trade that was the front week trade was $1.40, that's only 70 cents. I can buy this back for $2.50 in the morning. I may elect to do that. I may manage it a little bit different. My goal is to put this trade on as an earnings trade before the market closes. And then when the market opens the next morning, obviously we can't trade options when the market's closed, at least at this time. I'll take it off as soon as those spreads tighten. And that's normally, it takes 15, 20, 30 minutes, depending on the underlying. So that was a trade, and that's what's going on with that trade right now. And that's a real live example that we took this week. I threw in at the last minute a little chart to kind of give you an idea after I made my decision. This is obviously was done after the close yesterday, because you can see the expiration 4/16. But this one with the arrow pointing to it, that is the day. You can see it even shows they posted the earnings after the fact. And here's a case, and this is something you want to keep in mind. And I know that people that do earnings trades, and I used to be in this with the technical or fundamental analysis, they'll go back. There's some websites that I think are really good websites, but they'll go back 8 periods and look at what this thing did every earnings announcement. I am of the opinion of the random market theory and the efficient market hypothesis that everything that's known is priced in. Obviously, in this case, you got a binary event of the earnings. It's not necessarily priced in. I think what happened previously has no bearing on what's going to happen this time. So I look at it as a unique event. And that's just the way that I trade day in and day out. If you remember, the forecast, the overpaid analyst estimate was like 9 something. These guys doubled. They did like $18 in profit. Now you would have thought that stock would go to 500 if it doubled. It was traded at 330 or I think it was 330, and they double their earnings. You would think go to the moon. It just shows you that no one knows anything. And this is how the market treated this stock. I didn't show you the intraday thing, but it sold off for a while, went up for a while. But the reality is that yes, these earnings could have spiked the stock, but the reality is they're pretty much, 2 standard deviation move like this is going to capture, in most of the time, it's going to capture the moves, because I just find that that stuff is. The news and all that is already priced into the stock. So, yeah, I even tell people, I said, if you took up the CEO and he told you that the earnings were going to be double the expectations, our forecasts for the future are through the moon, you still don't know what they're going to do to the stock. So that's in most cases why I trade it neutrally. But there's give you a little kind of visual example of where Goldman Sachs stood and what the strangle looked like. Now, I also took this week on the 14th. I don't like to trade the airlines, but we were really bored. There's not been a lot going on. The volatility's been low. I did take an April 30th. This was one day later than Goldman Sachs. I went out an extra week because the premiums were so bad. I collected $1.19. I closed. You can see here on the right. I opened it for $1.19. I closed it for 95 cents. I think it was 90 or something at the end of the day yesterday, but. I'm not a big fan of airlines. They always seem to have some kind of surprise, but I took the trade and made a little bit of money. I mean, it beats a sharp stick in the eye, as they say. Now, here's how I book trade. And those of you that are Gold members know this, and you see this all the time, but this will just show you the earnings. This will be the earnings log for this quarter. And I'll review last quarter's. And you'll get a better example when you look at a lot of trades. But you can see here's the Goldman Sachs trade. I sold it for $347. My adjustment, I took off the put side for $18. So I'm sitting right now with a net after commission of $326.59. I'll probably, like I said, manage at the first of the week and make a buck or more on the trade. Shame on me for not getting out of it when everybody else did. Okay, on the Delta trade, same thing, 51.45 strike. I sold it for 119, collected 116.72. Here's one I actually closed, 415. I was in the trade for a day, bought it back for 95, 26 cents a commission. That's a net trade. The profit's only $21 per contract. In the room, I only trade one contract. I've got other accounts I trade multiple contracts, but I only trade one contract. So I feel like everybody can identify with trading one contracts, and then you can scale it to your account size, your comfort size. And there shows you the return and the annualized. Even the $21 on an investment of $730 is an annualized return of 192%. Of course, this is what a Starbucks coffee or two, but nonetheless, that gives you an idea of what the overnight return can be. Okay, now let's get into what I look for and what I'm thinking about in the future. Every week, I have a watch list of all the underlines that I trade. It's about 270 some. Those include ETFs. There's about 220, 230 underlines or stocks that obviously are companies, so they're not ETFs, so they do have earnings. And I update this. And the one thing I want to point out is you've got to double check these dates. This is the watch list that I have for earnings releases for this coming week for me. Now I'll check those again this weekend. I'll check them again Monday. You could pretty well bank on IBM coming out Monday after Monday after the market closes. But these are moving, and it seemed like last year after we had the big drawdown in February and March, less of these companies' earnings dates were etched in stone. So the one thing I'll caution you is, and I do it, I mean, I make mistakes. I'll do a trade, and because it says, okay, that when I don't check a couple of other sources, and I find out I was 2 days early or something like that. But this, as we sit right now, this is the list that I'll be looking at for the coming weeks. For the coming week, excuse me, from Monday through Friday. And what I'll double check and make sure that these dates are still pretty good. Now, what I've highlighted here, the ones with the green with the yellow type, are the ones that I'm keenly interested in. I'll look at all these. I won't trade them all, obviously. If I could do one in the busier times, I might do 3 or 4 a day, but 1 or 2 a day as we start to get into earnings season right now. And it's just starting to pick up. We just basically had the banks and a couple of airlines last week, and now we're starting to get into the companies, and this will ramp up until about the end of May. So I highlight the ones that I really have that I don't want to overlook, but I'll check them all. And then I'll have people that in the room will say, hey, John, what do you think about Johnson & Johnson, or what do you think about Biogen? And we'll take a look at it, and I'll suggest a trade, or if they've got a trade in mind, I'll look at the trade, tell them my thoughts on it, and that for what that's worth. And I may or may not put on a trade. And there are companies that come as time goes on. They come into play. We call it into play, where their Riot comes to mind, RIOT. That's, if you remember last year, Beyond Meats and some of those. So over time, something might pop up that we trade. And I'll add it to the list. Some will drop off that might have been merged with another company or just aren't active anymore. But this is what I start out with. I post this. Typically, I'll post this in the Facebook group. We talk about all the time, almost every day in the gold level group. But I'll be looking at these companies, and you can see over here at the right, the IV ranks are just minuscule right now for companies that have earnings coming up this week. They are very low. And that's indicative of a very low VIX that we have right now. It's been trending down for a year. So I wanted to walk through an example like I did on the one they actually did. I'm not saying this is what I'll do, but I wanted to give you an idea again of how I would approach it. IBM has earnings, it's on the 19th, which I believe, it's Monday after the close. So I'll be looking at IBM. It's not the greatest vehicle to trade. I wish it were Netflix or something this week. Maybe I should have used that for an example. But all these implied volatility ranks are so low that, that's just, it's really depressing the amount of premium we get. And it'll probably end up not impacting our winning percentage, but impacting the amount of premium we collect for this quarter. But hopefully something will happen and volatility will spike, and we'll get higher premiums. But like I told you on the Goldman Sachs example, here's IBM. I showed the 421 after market close. I think it's 419. I think that's that's what that said. I'll confirm that. But in any event, I looked at about 2 times the expected move, and I initially look at I looked at the 145 and 125. Doesn't mean I'll end up there, but I kind of look there, and you'll see that it's about a 15 delta on the 125, and what about 13 delta on the 145. I know the print's pretty small, but so I'll kind of start there, and then I'll go through the progression of on the right here. You'll see it's only $1.27. This is paying for the week. That's the front week. The next week is $1.50. A couple weeks out, 201. And then this drops down to 186. I did this slide after the market closes, so my sense is the spreads got really wide. I didn't really notice that when I did it, but or the other thing it could be it might be the ex-dividend date, because these dividends go into the pricing, obviously, of options, and IBM has a decent sized dividend, so that might be the reason. Then if I go all the way out to the 21st, which is 30 some days, it's 249. So that's how I look at it. That's how I kind of start, and then I'll kind of, when I get closer towards the end of the day, I might tweak it up. I say, I think I'm going to be a little more aggressive. I mean, IBM's missed earnings like 5,000 times in a row, so are they going to do it again? I may go a little more, I may move up the put side, or vice versa. But that's how I start, kind of mechanical, unemotional, just take a look at it, adjust, and then I make a decision. Is this really worth the trade? I mean, am I going to do, I'm never, I shouldn't say never is a long time. I will rarely ever do a strangle for less than $1. It's just, why take the risk? This IBM trade will probably cost $2,500 in buying power for an undefined strangle. So that's how I approach it. And we'll see how it comes out this week. So now I want to talk a little bit about what we did the past quarter. And this is for the fourth quarter earnings. We did obviously companies come out and report their earnings quarterly. I like to keep them in the calendar quarters. So all these trades we did were for companies reporting earnings for the period from October 1st to 12/31. And for us, it was obviously January 1st, trades that I took between January 1st and March 31st. I know this print is very small, and if you download the PDF, you can blow it up and take a look at it. Shows you every single trade I did, what we sold it. Here's the entry price. If I made adjustments on the trade, the entry commission, the additional commission, these additional commissions are the commissions for these adjustments, and then ultimately, what was the cost basis after I took the premium I collected, because I think every one of these was sell to open. They were all short premium trades. Took the premium I collected, I subtracted the commission, and I had $350, in that case, $350.45. And you'll be able to see that if you blow up the screen. But and then I keep track of when I closed it. It calculates how many days, what I paid for the close, what the net profit is, the net loss, etc., and the annualized returns. And there's something wrong with my formula. It gets a couple when the initial capital is too low, it comes up with bizarre. I mean, the formula should work, but it comes up with bizarre numbers. But beyond that, most of those are a regular annualized calculation. So that's the 67 trades that I took. Before I go to the next slide, this was a surprising quarter for me. The best quarter I ever had was the second quarter last year, the period from April 1st to June 30th, trading one contract. I was up, I'll have to post that, I was up over $9,000 trading a one lot. And that was because the volatility spiked so much from the drawdown, what was late February, early March. The volatility spiked, and we benefited by higher volatility. And it was like shooting fish in a barrel, but it was shockingly surprised with those results. Now, this quarter, I even prefaced this quarter, I said, guys, the market, the volatility is really low, and it still has continued to trend low. And I'm going to be looking for, to me, a normal quarter would be 2,500, 3,000, 800 to 1,200 a month, pick a number, something like that. That's what I would be looking for. This turned out to be a pleasant surprise, and I'll share those numbers with you. This is it says year-to-date performance. It's just the first quarter. But as you can see here, this is my spreadsheets that I put everything on. These are tabs on the workspaces on the spreadsheet that are automatically generated just as a result of me putting in the data in that trade log. So for the period, we entered 67 trades. We closed them all. And this is new for me. I mean, I'm usually milking these things and trying to get a little extra money out of it. I'm getting better on earnings trades of trying to get out of these as quickly as possible. As you saw in the Goldman Sachs trade, I'm still not out of that. I'm kind of milking it a little bit because there aren't a lot of new trades to put on yet. But I was proud of myself that I got all these closed, because usually I'll have some linger that I'm managing for weeks and weeks, and I'm making a commitment to myself to put these trades on, and I like to close them the very next morning and move on to the next trade. But if I can manage them to back to break even or just a decent profit, I'll hang in there for a few days. So anyway, we put on 67 trades. We closed all 67. I have none open. You can see we're 64 and 3. But the more important thing is you can see the winning trades. Our net after commission was plus 6,700. That's trading in one lot on about a $25,000 account. Now I have other trades that I do in that account, the regular trades, but as an example, the first quarter I did 125 trades overall. 67 of them were earnings trades. The volatility's been low, so the regular trades are a little more challenging to find. We're just sitting around waiting for the volatility to expand. And what I might add is our winning percentage, our results don't change. The probability of profits are all consistent with lower implied volatility. But what's different is we collect a lot more premium when the volatility is high. So we had as I thought, probably the second best quarter I've ever had. But I was shocked with what we were able to do. And on the side, I kind of went over the highlights. The trades, the average implied volatility rank was only 29%. That's probably historically low. We did 67, 64 winners. The average days in trade was 19 days. Now you say an earnings trade, hey, you're supposed to get in the day before and take it off. And as you guys know, I drink the tasty trade Kool-Aid. That's what those guys do. They trade a much larger account. They're running a show. They put them on. They take them off the next day, win, lose, or draw. And I think that's fine. And if you're going to do that, I would say do that consistently. Do it every single time. Get them off the next morning, win, lose, or draw. I kind of don't like to lose, and I'll typically hang in there and manage them if there's the possibility to manage it. So my average days, all 67 trades that we closed was 19 days, which is almost 3 weeks. That's ridiculous for earnings trades. But if you break it down, those that I closed the next day were 20 of them were 30%. The 7 days or less, so like a week or less, I was in the trade, kind of like with a Goldman Sachs trade I'm on now, 75% of the trades. So I milked them for a day or two. Oftentimes, if I put a trade on late in the week, I'll let it go over the weekend, because I'll pick, if there's a lot of theta decay, I'll pick that up over the weekend. And of all the trades that we see 30 days or more was only 4. So the number of trades that were adjusted was 20 out of 67. So that tells you that obviously for 47 of the trades, I didn't adjust. We never did anything. We might have stayed in a little bit longer, but we didn't do any rolls or anything. Now here's a breakdown on the strategies. This has changed a little bit for me over time. Most of my trades now are strangles, or what I'll call synthetic strangles, where I'll put a strangle on and then I'll add wings. And if we want to talk about that later with the Q&A period or something, I'm happy to go over that. But let me just real quickly go over this for you. Again, 67 trades. The number of trades by strategy, I did 44 undefined risk trades. Those are most obviously strangles and double ratios, or both undefined risk. And then defined risk was 23 or 34%. The wide iron condor, I kind of put in the same class as the strangle, because it's really a strangle, but then I add wings to either define the risk or, in most cases, to reduce the buying power. And if you're trading an IRA account, some of you that trade IRA accounts, you know that you can't, in some brokerages, TC Works being the exception, but in some brokerages, you can't use short calls, and all your puts are cash secured. So it may take an inordinate amount of capital. I put on a trade, say at a margin account, it's $2,500. It might cost you, if they allow you to do it, it might be $11,000 or $12,000 or whatever, and on in a account. But most of the brokerages don't allow an IRA's naked call, so you're forced to put those wings on. So just We did 3 naked short puts, a broken wing, only 1 broken wing put butterfly, a put calendar, which was that was a buy to open. I said I guess I did all but 2 were sell to opens. Jade lizard, a cover Jade lizard, and double broken wing butterfly. So that's the breakdown of the strategies. And if you do download the PDF, you can review that at your own time. Now, what we do, I'm wrapping this thing up. I do have the gold level membership. This is what we do. Not only do we do earnings trades, but we do regular trades. I mean, that's majority of what we do. And I said the first quarter, I've done 125 trades. 67 of them were earnings trades. And I'd like to do, my goal would be to do at least 10 trades a week, a couple a day. Doesn't always work, but I've got a membership, just a small group of like-minded traders. And if you've got questions on that, I'm happy to answer. This is a little screenshot of what I provide. I post, I'm going to show you, I post all my trades real time and on right in the room. Like right now we added, one of the members suggested that we add another chat. So the private group that you see on the left, I post the trade in there, even when they're working, the little W yellow. And then if the trade gets filled, I post the fill. You can see this Goldman Sachs fill. Then what I do, we open another that's just trades only. There's no dialogue in there. I simply post a copy of the trade. Now, as a member, you've got to look at it, and you can double click on these and make them in real size. But you can see if they're, buy to close, sell to close, because it doesn't indicate. I don't type anything in there. There's no dialogue in this room. And what that is when we just had the private group, you might have to scroll back, way back to see what I did for the day. This way you can go in and, click, you can see at 10:36, I did this trade, 10:56, 11:08, and then if you want some explanation on, just look at the timestamp and then go to the private group, and I might have talked or a member might have asked questions about it, etc. I put in here's the contact information and resources. If you have any questions, if you're familiar with my website, it's optionsmeister.com. I've got a Facebook group. Most of you are members of the Facebook group. We post some content in there. I've got a YouTube channel and the gold level membership. I've got the URL there. Online courses. I'm in the process of updating those online courses and some new ones. And then I've got a couple published books on Amazon, both Kindle and paperback versions. So that wraps it up. I wanted to go through it because I want to give you plenty of time for Q&A. And if there are any, I'm happy to do that. So I really appreciate your attending today, and I hope you were able to pick up something. And I didn't want to dumb it down too much, but I want to show you how easy it really is, or once you get comfortable doing it. Okay. Oh, there you go. Well, thanks, Shirish. I appreciate the compliment. That's what we're here for. Walter, the way I get the trades, you'll get them in that. I post them in Skype. I don't post the text, and I post them in Skype. And then if you've got a smartphone, you can just have Skype on your smartphone. It'll come through. I'm not adverse to looking at another service other than Skype, but I've been using it for several years, and it works. I can post a screenshot in there. In the one chat, we talk. People ask me questions. I encourage questions. I love questions. And what I didn't mention, part of the gold member, is I have a live room. We trade futures in the live room. Then I'm able to, if someone asks me a question in either of the chats, either the live chat or the Skype chat, and they're available, they're at home or they're available in the live room, I can go in there and answer the question, because I always say I can talk a lot faster than I can type. But so I don't have a text of the trades, but what you do is you'll get a live screenshot, you'll get some comment, and then if you have a cell phone, I would download it on your cell phone, and the Skype application, you'll get right on your cell phone. Hey, Steve, I know we've been talking to you for years, trying to get you over here to the dark side. So I jokingly call it the dark side, but pretty good. Good question, Richard. Yeah, and Richard's a member. I know you'll probably get to see this up close and personal. Outlier moves are always fun, and they're going to happen. What I tell people, and whether it's a regular trade or an earnings trade, remember on earnings trades, I'm going a little bit further out. Typically on regular trades, 45 days to expiration, I'm working on that 45-day time window, and I'm about the one standard deviation, so about that 70% probability. So on earnings trades, about that 95% probability, but you're going to have outliers. We had one last year in CRM, and those that are in the room that remember that trade, how we managed it. But what I would say, if you do strangles, they're the easiest to manage. I mean, they're the most painful because they take a lot more buying power. But if what we simply do is, and this is right from the Tasty Trade playbook and from their research, but what we do is we roll the untested side. So if we had that strangle on in Goldman Sachs, and let's say it was 347.5 call side, it blew through that, I would roll the put side up. And then if I couldn't exit it for a scratch or a profit, then I might roll that whole trade out. And you'll I don't say it's fortunate or unfortunate, but we'll have some outliers. I've got a few now, inverted strangles, and we'll take those. You can do that with an iron condor if you have wings on it. If they're far enough apart, just with the four wings, they're a little more challenging to adjust. But I typically don't throw in the towel, until it's not over till I say it's over, I guess. And most of the time, if you get an outlier move on an earnings trade, it might be 3 or 4 times expected move. So it's manageable, and I'm sure we'll have one or two this cycle, maybe hopefully not more, but we'll have some. But you always want to roll the untested side. Now, if you're doing a defined risk trade, let's say you did instead of doing a naked put, you did a put credit spread. Normally, if the price, if it doesn't work your way, obviously you put the trade on, and let's say you put it on for $2, and it's $6 wise, so you collect a third of the width of strike, put on for $2, and you're kind of putting on the spread trade to define the risk instead of you're short the put. And if price goes through there and it gets between those strikes, you can typically roll those out for a credit or zero. So you can extend duration. You never want to take on more risk. I never throw good money after bad, so I never add money to a trade. And if it comes down to expiration, I haven't been able to exit it, I just accept the loss. Well, Walter, I've been on toss for years too, and I do have I trade for a couple clients on toss, and I've got a small account still left on toss personally, and I trade a couple accounts on Tasty Works. I would concur with you on the charts. I know they're improving charts. I don't use charts, so that's immaterial. The only immaterial to me, the only reason I'll look at a chart, let me see if I can, let me minimize something, and I'll bring that. Let me bring up a chart. Let's see. Let me bring, here's the, if I were looking at a chart, I mean, the only thing I would look at a chart for an earnings trade or for any trade is this thing spiked up, spiked down. It just kind of gives me a visual of, this thing is, is it kind of am I going to do a neutral trade or more or less a directional trade? And probably a good example, the one that's been my pet peeve lately, is Home Depot. And I don't do any indicators or anything. I mean, this is the implied volatility rank, but you can see this Home Depot's parabolic, and I'm short Home Depot right now. And I told someone yesterday, I was chatting, I said, if I had a big account, I'd be shorting this thing till my hands bleed. But I would concur with you that that the charting package is not as good, although they just did an update, Walter. If you saw that, they just did an update. And they've improved the charts, but again, they're not important to me. I've got, like I said, I have Thinkorswim, and some people ask me, and I'll bring up the if they got a question on Thinkorswim, I'll bring it up. So, but I would do that. But if you trade if you trade non-directionally like I do, the charts are really not that material. That it sounds like I'm blasphemy, but they're really not. Oh, thanks for the compliment, Craig. Appreciate it. I've known Craig for a long time. We were a member of an options group down here, and he just joined us recently. So great. Yeah, that's the one thing I point out. I'm not just a trading service or I text you out trades. I'm here during most of the trading day. We're busy. I'm talking all Eastern times, but usually slows down by about 11. But I make myself available. People can ask me questions in the private chat, or I'll go into the live room and answer questions. And I think, any monkey can send out trades, but I think and like I said, 20, if we put on 100 trades, 25 of them will just take off, or 20 of them, something like that, take off as winners, and they'll hit our target and blah, blah. And about 20 of them will have to adjust, and we might get it back to a scratch or small loser. Then 5 of them are the old PIA trades that you've got to deal with. Well, yeah, let me know how I can help, Evan. Just stay in touch. Hey, thanks, Dave. Well, thank you. That makes sense. I hope I appreciate the compliment. But yeah, if you've, I know some of you read the book, so yeah, that's true, Walter. Hey, Stefan, thank you. Stefan, that's interesting. I don't quite understand that, but that's what Jan told me, that they've made some changes over there. Hey, way to go. Thanks, Jay. Yep. Yeah, here's where's my camera? Yeah, there's my one book, Options Trading. So yeah, they're both on, on Kindle. If you're Kindle Unlimited, you get it for free. I think they're $2.99 or something like that. But trust me, you don't make any money. Thanks for the compliment, Jay. Appreciate it. Sure. How challenging are the well, I guess I would say every trade can be challenging. Most of my trades are contrarian, so I guess you could say all my trades are challenging. But if you're saying how much are challenged, I would say probably pretty consistent. What we have on that one slide for the earnings trades, I only adjusted 20 out of 67. So was that a third? So that is, we're probably going to have 20-25% that need adjustment. Doesn't mean they're going to be losers. The one thing I would stress to anybody that trades earnings trades regular trades, and that's what I said early in the presentation. What I'm telling you here is exactly the same thing I'll do on a regular trade. It's just I typically work in that 70% probability of profit or one standard deviation area, as opposed to going wider on the earnings trades. But beyond that, it's all the same. The management's the same. The mechanics are the same. We exit them a little bit quicker, but typically they come in quicker because of the volatility. So we're probably going to have over the course of time, sure-ish, I'd say, 3, 4, 5% earnings lose, really pain in the butt trades. And it also depends if they're defined risk. If you're doing credit spreads and iron condors and that, your winning percentage, if you manage at 50%, you ought to be in the high 70s, low 80s. But you're not going to have, if you do a $5 wide iron condor or credit spread, and you collect $1.70, you collect a third of the width of the strike, you're risking 330. You're only going to have a few of those that are total max losses. I had a couple this week on Lemonade. I don't know why I ever traded that stupid thing, but that's just trading, so. And to Craig's point, you're welcome. Sure. To Craig's point, I trade he knows I trade the MES. I like to use the MES to provide negative deltas for me in my portfolio, and that's a discussion, maybe another webinar. I'm going to start doing these more frequently. I did a poll a couple of weeks ago or a month ago and got some ideas on what to do. So, with earnings being so it being earnings season, we just came off a pretty successful earnings season. I'd talk a little bit about earnings, but bear in mind the mechanics are very similar. I like micros, and so good. Yep. I don't know about that. Yeah, I just, Steve, it's all blocking and tackling. You have to be, you've got to get to the point, and that's part of a much longer discussion, or a part of one of my online courses, but that I'm working on. But you have to get to the point that you're mechanical and unemotional. If you're ever emotional about a trade, you're trading too large. Cut your size back, or if you're doing the futures, go from the regular ES, go to the micros for a while till you get your confidence. And they trade exactly the same way that the regular ES does. But I'll stress, and I know and I didn't talk about it earlier, but I keep records of every single trade. You see the spreadsheet that I use. It's a pretty detailed spreadsheet. Oh, I do want to I forgot to, I share, I want to upload that PDF for you. I told you. All right, you should be able to see it. Let's see if the hand, shoot, what did I do wrong? Let me get this handout. Is the handout available now, or did I mess that up? Yeah, thanks, Steve. Appreciate it. I thought I uploaded that handout. You should see it. If you click on handout up there at the top and you want the PDF, it should be there. If not, or email me, I'll send you the PDF. But I thought I uploaded it earlier. There we go. Finally. Okay. Now you should see the handout out there. I should have done that earlier. I apologize. So if people left it, then we're gonna miss it. But I can always send it out. So you should see that handout. So are there any other questions? It's about an hour, but I'm happy to sit here and help answer questions. I said I wanted to make it keep it around an hour. And hey, Jim, great. Way to see you. Thanks for getting the handout. Great. Walter, and I'll get to your question in just a second, Dave. Walter, I trade the ES from about 8 in the morning Eastern to about 11. And then I keep it on if you came into the live room, you'll see the futures charts up all day, because I like to keep my eye on what's going on in the market. Because if I'm going to trade Apple, I want to know what's going on at the NQ. But that doesn't mean that at 1 o'clock I wouldn't take a trade. But I would say most of the activity happened, and I don't know exactly what the Asian market is. That started about 4 in the morning. So I start about 8 a.m. Eastern, 7 p.m. Okay, the overnight. Okay, I used to be involved with Traders Den 24, and that's what Bill did. He traded overnight. I don't trade. I do not trade the overnight session, and I usually have the live room on between 8 and 4. So, and Dave, your question on standard deviation. Let me show you something. I did this little thing. I did on IBM. If you can see the screen there, Dave, the price is 133. So you take the price times the implied volatility times the square root. In this case, there's 6 days to expiration, times the square root of the days to expiration over 365. That's the factor. But I do it in one formula. And this is a back of the napkin calculation. So this was IBM. So $6.70 is the one standard deviation range based on the closing price Friday. And so you take the price of 133, it adds 7 or take away 7. So does that answer your question, Dave? Yeah, Walter, I used to be in that room, if you remember. Bill Costaritas, and yep. I did the options part. I didn't do the overnight session. Bill did. In fact, I still have the trader. I purchased the Traders Den 24. my thought has been to get that fired up again at some point. So, okay, Dave, that answers your question. And again, this isn't the Black-Scholes model. Okay, Sheriff, I know you're way ahead of us. Have a good weekend. So, okay, let me take that back down and answer Dave's question. I will edit this, render it, cut all the oohs and ahs and everything out of it, and get it out to everyone. So I'll give it a minute or so. Give me if there are any other questions. It's 10 o'clock here Eastern, and teach it in. Hey, thanks for coming, Jay. I appreciate it. Thank you. Hey, Greg. Thanks, Greg. Thanks, Steve. Thanks, appreciate it. I'm going to come up with a topic for the next one. Hey, that sounds like fun, Dave. Yeah, my grandkids are all in Cincinnati. A couple of them are playing lacrosse down in soccer. So you're welcome, Walter. Thanks for coming. I appreciate it. All right, I'm going to wrap it. Thanks again. I will see you members. I'll see you Monday, and everybody have a great weekend, and talk to you later. Thanks.